Everybody. This is our last CRT webinar for the year, and we can go forward one slide. I'm really happy that Tanya DeLia has joined us today. Tanya is our Vice President of Collateral Risk Management, and she's going to do a deep dive on our collateral analysis. And so we thought that would be a good topic for many of you to kind of get that perspective. So welcome, Tanya. Thank you for being with us today, especially on your birthday. Okay, next slide. But first, let me go through, we usually tap into our economist's office, and we pull together some slides that we think will be relevant for our audience. And so I'll take a few minutes going through that, and then we'll hand it over to Tanya. So the first piece, and we can see here on all three charts, job growth, job openings, and quits rate, the labor market is cooling. So if you look in the right-hand side of all three charts, you see job growth is slowing down, job openings slowing down, and the quits rate is slowing down. However, from a historical perspective, these are still all very, very strong, robust numbers, as you can see, going back to 2000. Next slide, please. The consumer balance sheet is something that a lot of folks have been monitoring and watching. We saw spikes in the savings rate, spikes in the consumer deposits during and post COVID pandemic. And now we're starting to see those numbers are coming down, and we're starting to see some consumer loans going up. So it's something that folks should be paying attention to monitor the strength of the consumer. We'll talk about housing and the strength of housing in a minute, but for sure, these are some things that have got our attention, and I'm sure you all are following as well. Next slide, please. Mortgage rates have made it very expensive for homeowners to move. So we have some lock-in effect that is definitely impacting supply. The chart on the left shows the average mortgage rate. It's a little dated, 744 today. It's 7%. So we've seen some respite from that based on market anticipation of Fed moves next year. So it's around 7%. That said, according to NAR, housing affordability has fallen below 100. So at 100, the median income borrower can afford the median home with a 20% down payment. So when you fall below 100, per their statistics, you're seeing they can't quite make that payment. It becomes a little bit of a stretch. So that affordability index has come way off of its peak that we saw earlier in the last decade, and it's back down to the 2005 levels. Next slide, please. Home sales are continuing to slow down, and we have the lock-in effect. We have a lack of supply. This is despite pretty massive demand. You can see home sales on the left-hand chart has come way off of its peak that we had back in 2020. You're back at levels that are 2009 timeframe. And if you look on the right-hand side, the green line, which represents new home sales are for a few months in a row now are exceeding existing home sales. So that's a little unusual. Historically, existing home sales is by the much larger portion of that. We had a small little change over there in 2020, but we've had a few periods in a row now where new home sales are actually the majority of the home sales that are happening. And that's going to be a theme that we've talked about in past webinars, and we continue to, I think, be a driver related to U.S. residential. Next slide, please. You've heard me, if you've listened to any of my past webinars or things that we've done, across the team, demographics are front and center of a lot of what's driving demand. And we continue to see that millennials, as they're such a large cohort, and they are driving demand. And if they were to achieve home ownership rates, or it should be headship rates, head of household rates, that's what this chart is. If they were to achieve headship rates similar to previous generations, such as Gen Xers and Boomers, you would have 2 million additional households. So that suggests there continues to be a lot of pent-up demand for headship rates, which require units to occupy, whether those be ownership or rentals. Next slide, please. Supply is at record lows. This is a continuing story. The total inventory, if you look on the left-hand side, is at a 20-year low, practically bouncing around at a 20-year low. And as suggested by the earlier chart, we're seeing that most of the inventory that is available for sale is new home inventory. Existing homes are just not really turning over. And again, you think a lot of that would be related to mortgage rates and the lock-in effect and people not wanting to leave their 2.5 or 3 or 3.5, whatever their mortgage rate is. So new home inventory is starting to move up, and existing sales are just not very significant in the current environment. Next slide, please. Home prices are very robust. We're seeing a 5+% across the nation. We'll go into that chart in a second. If you on the left-hand side, we're doing year over year. On the right-hand side, it's month over month. So you can see on the left-hand side on a year over year basis, and this is the Freddie Mac home price index, house price index. We've had positive throughout, going all the way back to since it turned back in 2012. On a month-to-month basis, we did have a dip, and you see that in the right-hand chart in the lower right-hand corner. Earlier in 23, we had some month-over-month negative prints, but those have rebounded, and this is dated as of September. Next chart, please. Home growth across the country is very robust. The darker colors are the states, year-over-year growth as of September. The darkest colors are the states that have the most growth for this time period. Overall national average, 5%, 5.2%. We have one state, Louisiana, that did print a negative year-over-year growth. And you can kind of just, with the exception of New Mexico, you can almost draw a continuous map of the states that have slower but yet still positive growth. I will highlight also DC and Hawaii also falls into that light blue category. But generally speaking, you're seeing very robust growth across the nation. Next slide, please. Related to that growth is we're seeing, we now have 20 trillion in home equity above the 2000 peak. So home equity peaked back in 2006 prior to the great financial crisis. We had a dip. Mortgage debt outstanding has remained relatively flat. We're starting to see some growth since 2020. But what we've really seen with the home price appreciation is a massive movement in equity. And so the consumer balance sheet from an equity perspective continues to be very strong, the strongest it's been. Next slide, please. I'm going to go into some CRT specifics, and then I'm going to hand it over to Tanya in a few minutes. So next slide. CRT, we've issued just under $4 billion this year, which is a fraction of the business that we've done in 21, in 22 and 21. We had very, very large years. Much of that is directly tied to rising mortgage rates, lower acquisitions for Freddie Mac, and some changes in our management strategy where we've been focused on CRTing the collateral from 2022, much of which we actually had done during calendar year 2022. That said, the year is still very, very busy. We've had $4 billion active in both product lines, Stacker and ACEs. During that period, we continue to attract new investors. So we've had 13 new participants between Stacker and our capital markets and reinsurance products, and totaling 128 unique investors. So that's a this is all on primary print. This is not reflecting anything that happens on secondary. So a very, very broad credit market continues to exist, even with some lower volumes. And then, of course, we've been very active with our tender offers, executing one per quarter, and just over $3.5 billion bonds tendered during the year. Next slide, please. Spreads continue to remain elevated. Generally speaking, 23 has been a very great year. If you happen to buy bonds or earlier in the year, and you're on the capital market side, you've seen some significant home price appreciation, security appreciation, price appreciation, as spreads have tightened during the year, and you can see that really across the stack. Although they remain elevated, If we look from a historical perspective, our M2 bonds are, still, despite the spread tightening that's happening lately, and again, it's been a great fall from that perspective, and really a whole year. Spreads remain elevated, and they remain elevated across the stack. You can see that we don't have any B2 prints here on here lately because we just stopped printing them. They really just became much too expensive for us. And if we go to the next, and that's across both low LTVs on the left and high LTVs on the right. As always, I'm going through these slides fairly quickly to give, not to take too much of your time, but these slides will be available for folks that want to dig into it further. And my team, all of us are always available to follow up with any specific questions. We're seeing a similar trend on the next slide. That's for capital markets. We're seeing a similar but muted trend on the ACES side, our reinsurance product. So we have seen some tightening of spreads lately. Generally speaking, spreads remain elevated relative to where they were for the past couple of years. But again, it's been a good fall in terms of spreads. Next slide. I mentioned this earlier, 128 unique investors, very, very broad. We're really pleased with that, to be able to have attracting so many differing sources of capital. The participation has shifted somewhat. We have seen year over year from 2022 to 2023, if you look on the right-hand side, we see a shift where hedge funds have become a larger share of our total placements. And money managers coming down a little bit, reinsurance is coming down a little bit. Now, part of that is reinsurance in 22 had a really, really massive year. It's a fantastic year for reinsurance placements. So that's a portion of it. And it's also, I think, just the nature of the market and who's bidding on those primary prints. Next slide, please. Outstanding performance on outstanding bonds continues to look very, very robust. So this chart contains, this chart contains both credit event losses and mod losses. So the darker blue is credit event, the mod losses is the light blue. If you look back at 2015, you can see the majority of losses for that book year was credit event. You look at more recent years, 2019, the majority of losses is related to modifications and DPP, deferred payment plans. Look closely, as I've said in previous public engagements, look closely at the y-axis. Those are basis points. Peak losses for any year is between 1.5 and 2 basis points. So losses continue to be very, very, very low. Leading indicator of losses on the next slide is delinquencies. So our overall seriously delinquency performance is really strong. So Freddie Mac is for the total Freddie Mac book on the left-hand side is right at 55 basis points, well inside FHA and VA performance. And if on the right-hand side, which is the CRT outstanding book, which is a subset of the Freddie book, we're actually at 43 basis points for an SDQ rate. Very, very strong. And then we move to the last slide. Next slide, please, before I turn it over to Tanya. Just to look back, and these are charts that can be generated out of our Clarity tools, and again, these slides will be available. Folks can dive into it. Where are the loans from a 12-month transition rate? So for loans that were current in October 2022, the leftmost column, 94% of those remain current, 5% of them have prepaid. So 99%, no type of credit event whatsoever. That 1% is somewhere in the D30 to potentially credit event. For loans that were seriously delinquent, D90 to 150 in October 2022, 53% of those are current, 12% are prepaid, and then you can see the rest of the profile. The loans that are 180 plus, so now we're going for another 90 days. You're seeing a very similar patterns. 52% are current, 13% are prepaid, and about 20% of those remain in a D180 plus or worse environment stage. And we've got about 3% of those credit events. So bottom line is actual losses continue to be very, very low. The housing fundamentals continue to be very, very strong. The consumer balance sheet is strong, although you should be paying attention to where jobs are, into savings, into the borrowing credit cards and other forms of debt. But what we've seen is very highly effective loss mitt programs when the borrower does run into distress. So to dig into a little bit more on collateral, I'm going to turn it over to Tanya. And Tanya, I'm going to hand it to you, and then I'll come back at the end, and we'll take some questions if there are any.
All right, great. Can you hear me all right?
Yes, I can hear you. Sounds
awesome.
Good.
Well, thank you. Thanks for having me, Mike. I'm always excited to talk about all the cool stuff and interesting work we're doing kind of to advance being able to assess collateral. When I say collateral, I mean property that is, backing the mortgage transaction. What I thought that would be helpful first is if I spend just a couple of minutes sharing kind of our vision and how we think about development of new valuation methods. And then I'll provide some insights into kind of some of the enablers, the things that enable us to develop new capabilities. And then lastly, I'll share the trends in terms of collateral methods that are out there, our offerings, what we put out recently, and what we're testing. So kind of taking a step back, when we think about kind of developing new property valuation capabilities, what we really want to do is excel on a number of fronts. We want to make sure that what we do has sound risk management, obviously, because mortgage lending is collateralized lending, right? Collateral matters, the property matters. We want to simplify the loan manufacturing process, which usually entails, in addition, reducing costs for lenders and consumers. And we want to promote more consistent and fair valuation outcomes. So for me, we got to hit on all three fronts. It's not an either or, but we got to hit on all of these fronts in order for us to kind of move forward. And this slide that is on the page now is a good kind of visual representation of what I'll call the valuation spectrum, right? If you think of the valuation options as a spectrum, you'll see that on the right-hand side is what we're all used to, the traditional appraisal, right? It's one where the appraiser is licensed by the state. They go out to the property, they perform an interior or exterior inspection, they go back to their office, and they do their research, develop their analysis, and then come up with their opinion of value. And that appraisal obviously is used by the lender. It's been around forever in our guide, and we've used it and continue to rely on it. On the other side of the spectrum is ACE. ACE is our automated collateral evaluation. ACE leverages a combination of models and algorithms to help us get comfortable with the estimated value that's submitted by the lender on the application, as well as condition and marketability. It's been around, it was introduced by Freddie Mac in the guide in, I think, circa 2017, and we've since continued to enhance those ACE capabilities. And everything that's in between those two kind of ends of the spectrum is all the things that we've either rolled out or are actively in the process of testing. All in all, I think we've made really good progress in this space over the last, 5-6 years, but there's still a lot of work to be had. So, I'm excited to be part of that journey. And then underlying these different valuation capabilities is what I call kind of the enablers, right? These are the things that actually enable us to develop various valuation methods. And I'll spend a little bit of time kind of double clicking on some of these and then highlight others as well. So Home Value Explorer is Freddie Mac's automated valuation model, AVM. It is an ensemble model, which in essence means that it consists of multiple underlying models that are ensembled together, kind of if you think of wisdom crowds, right, to come up with the best prediction. And HVE is used in our various offerings like ACE, as well as inspection-based waivers, what we call ACE plus PDR. And it gives us kind of two data points. It gives us the market value of every property, single-family property, as well as a confidence score. And we use both of those data points to help us design our algorithms and our collateral risk assessments. Natural language processing is another enabler for us, and I have a whole slide on that, so we'll talk about that shortly. Computer vision is also a fairly exciting thing. It is the ability, using AI and machine learning, to gain a high-level understanding from digital photos as well as videos. And we're actively evaluating vendor capabilities and then building our own capabilities in-house to assess opportunities to leverage computer vision in performing collateral risk assessments. The opportunity there is significant. I'm excited about that. And then we have scanning technologies. Actually, I'll start with scanning technologies. So next slide, please. I'll go into that a little bit more. So back in the day, when you think about somebody lists a property, a real estate agent lists a property, they would hire a photographer to drag in this massive piece of equipment to take photos or videos, scans of the property. And that has come a long way. The technology there has come a huge long way. I would venture to say that most of you have something in your pocket called your iPhone that can now do the exact same thing for a much, much lower price point. So why do we care? Well, it's enabled service providers to develop solutions such as property data collection at a really, really competitive price point and incorporated into our kind of valuation capabilities. So a couple of things that benefit us kind of from a risk management perspective. iPhones have this thing called LiDAR. It stands for light detection and ranging. And it basically allows the service provider to walk around the property and scan it. It uses lasers to kind of measure and get a visual representation of that property, each room. So what does that entail? If you have a service provider like a property data collector that can walk around a house from room to room, they can scan the house, kind of scan the windows and floor areas of the house, each room. They can then turn around and produce a floor plan, a comprehensive floor plan, one that is consistent because it's produced in an automated fashion, and it measures the property. So compare and contrast that to the traditional appraisal process where you have human beings who are maybe using a tape measure or a roller or a laser, all kind of in their own unique way, and producing not only like a back of the napkin sketch, yet and the measurement. Compare that to the floor plan, which has a lot more information. And the visual kind of on the lower right-hand side shows you what that floor plan looks like. Now, why do we care? Well, we care because it's much more detailed. It shows windows, doors, interior walls, dimensions. It gives us the ability to have consistency in how gross living area is actually measured. And it improves the ability for lenders and us to identify things like functional obsolescence, right? Do I have to walk through a bedroom to get to another bedroom? I would venture to say that that might have an impact on a property value, right? Because that's kind of a wonky layout. So leveraging these kinds of technologies within our service, within our valuation methods, helps us kind of get more consistent, repeatable, and transparent processes. We're also looking at 3D scans. That's another area where we're trying to identify how we can incorporate those into valuation methods that we allow, because these 3D scans, again, through your iPhone, allow you to take a much more comprehensive view of the property. You can pan up and down, you can go side to side, kind of walking from room to room, and it allows that comprehensive view to be shared to downstream consumers like us as an investor of the property. So lots of exciting elements here that are helping us kind of get more comfortable with offerings like inspection-based waivers. Next slide, please. The other capability, the other enabler that I wanted to highlight is natural language processing. So what the heck is natural language processing, right? So basically, natural language processing is a branch of artificial intelligence, and it allows computers to read regular text, or actually it allows computers to even listen to spoken text and interpret and understand human communication in a way that's similar to how people process language. So this has been an exciting development for us because we now use natural language processing to help us in our collateral risk assessments. We have incorporated the use of MLS listing text into being able to assess and predict condition model on a property to help determine whether there's a higher likelihood of a property being in poor condition. So I gave you a little bit of like a word cloud just to illustrate kind of how this works. This word cloud is based on feature importance specific to being able to predict whether a property is in poor condition or not. And basically, if you look at this, the green words, right, are words that might be predictive of whether a property is in better condition. You know, dishwasher, granite, custom, things of that nature. Red words might be words that might be highly predictive of properties that might be in worse condition. Handyman, opportunity, fixer-upper, TLC. Size kind of indicates how often those words are used, and the shading kind of helps articulate the feature importance or the impact to that prediction. So this is one example of how we've incorporated this AI machine learning capability to help us better assess the property from a condition perspective. Next slide, please. Now I'll kind of switch a little bit to talk about ACE, provide a general ACE update. So as I mentioned, ACE is our automated collateral evaluation. If a lender offers, if we offer ACE on an application submitted to us to a lender, they are able to accept ACE. They don't have to, but they're able to accept ACE in lieu of having to get an appraisal. And as I mentioned, ACE leverages a number of models, HVE being one of them, condition model being another, as well as algorithms and a plethora of data, which we have a ton of data at Freddie Mac, to help assess the market value and condition of a property. And we were very deliberate when we designed ACE in that we leverage not only the value that our AVM produces, but also the confidence score. And we designed ACE so that with the thought that ACE loans would perform at least as well as loans that are supported by appraisals, of course, on a risk-adjusted basis. And I'm happy to say that, you know, so far the results have been very, very favorable. The slide, the table to the right kind of shows you funding year by funding year since we started ACE. We show performance of ACE loans leveraging the ever 90-day delinquency rates, comparing kind of ACE funded loans to loans funded what we call an ACE peer group, which is within the same credit box, right? Because we want to compare like for like loans and make sure that it's a fair fight. From an overall trend perspective, the other thing I wanted to highlight is that the percentage of loans that we're funding that are leveraging ACE has decreased. Now, there's a couple of reasons for it. The most fundamental reason is that we moved from a refinance market into a purchase market. And ACE is allowed today for refinances up to 90 LTV, whereas on our purchase, we're at 80 today. And also, we tend to, our offer rates for ACE tend to be higher on refinance transactions because there's more information about that property available to us in a refinance transaction, right? It just makes sense in that transaction probably transacted as a purchase. So we might have a prior appraisal, we might have listing information, et cetera. So So that's kind of the trend. The ACE has gone from, I think in 21, yeah, I note here, 39% overall book of business was ACE, dropped to 18% last year. I think we're hovering around 13, 14% so far year to date. Next slide, please. The other thing I wanted to spend a couple minutes talking about is ACE Plus property data report. So in July of this year, we announced the availability of what we call ACE Plus PDR. What this is it allows, so we will assess the application that's submitted to LPA, and based on our ACE and ACE PDR algorithms, we will make available to a lender the option to use ACE Plus PDR via LPA. What that allows a lender to do is to hire a data collector, and the way this is being operationalized in the market is appraisal management companies who lenders engage to manage the appraisal fulfillment activity. These appraisal management companies are also standing up panels of property data collectors. So it allows a lender to hire a property data collector, send them out to the property, and they perform an on-site visit, capturing pertinent information about that property. A ton of photos. They typically do the scan that we talked about from their iPhone that allows to produce the floor plans and such, as well as collecting detailed information about the property. And then the lender uses that property data report to review everything and make sure that it meets our requirements in terms of property condition. In an ACE Plus PDR situation, the lender submits the estimated value or the purchase price to us. And if we offer ACE Plus PDR, it means that we are comfortable with that value pending that property data report being fulfilled and reviewed. In August of this, so when we released in July of last year, we made it available for cash out refinances and certain rate term refinances, no cash out refis. And then in August of this year, we expanded ACE Plus PDR to certain purchase transactions. I'll say that lenders are still kind of in the early stages of adoption. We have about 50, a little north of 50 vendors who have operationalized this property data collection product. And to date, we funded roughly 8,000 loans leveraging ACE Plus PDR through October. Of course, when we tested this product before we released it, made it broadly available. And I will say that the test results were really favorable. We were quite pleased. We saw a much more accurate assessment of the property's condition as compared to appraisals. We also saw an improved kind of manner to identify whether a property required repairs or potentially required an inspection. So we saw improved identification rates there, and much more richer information that we are able to collect, obviously, and also benefit from that more consistent measurement of gross living area. Next slide, please. So now kind of switch back to appraisal, kind of the appraisal side of the evaluation spectrum. So during COVID, obviously, there were a ton of concerns around folks, going into people's homes for understandable reasons. And we launched under kind of FHA guidance, and in collaboration with Fannie, we allowed the use of desktop appraisals. So what's a desktop appraisal? So a desktop appraisal basically allows an appraiser to develop their opinion of value without having to actually visit the property. So they rely on available data sources sitting at their desk to develop that analysis and that opinion of value, which is why it's called a desktop appraisal, because they're sitting at their desk. During COVID, we made that option available for purchase transactions, and we were very deliberate there. The reason why it's not available on refinances is because for purchase transactions, there's typically a lot more data that's available to the appraiser to use to assess kind of perform their analysis. If you think about it, typically in a purchase transaction, there's an MLS listing. They have access to photos. They may even have access to virtual tours, which is why we only made desktop appraisals available on purchases. We obviously were very thoughtful about designing policy mitigants that would help manage the risk of purchasing loans in poor condition. And we have certain parameters for when desktop appraisals cannot be used. As an example, if an appraiser is not able to get sufficient information about the interior or exterior of the property on that condition, they can't use a desktop appraisal. They have to upgrade to a full traditional appraisal. They can't assume anything. They have to have information readily available to them. We also require a lot more photos on desktops. And similar to ACE Plus PDR, we require the use of a floor plan that's included with dimensions, inclusive of kind of all the interior walls and everything, like that photo that I showed you on the prior slide. And this was done kind of strategically in that we want to incent the industry as a whole to start using these automated data collection methods like the floor plan scans, et cetera, inclusive of real estate agents and such, which is why you see more and more these floor plans are included in listings. We obviously beat desktop appraisals up quite a bit during COVID, performed a ton of QC to make sure that we didn't see any elevated risks, which we did not. Did not see any elevated risks of valuation or condition concerns. But generally speaking, desktop appraisals really don't make up a ton of our business right now. I think all in all, it makes up about 2% of purchase loans that were delivered to Freddie Mac since we allowed it in 2021. And honestly, right now, it's even lower in terms of usage. And what's driving the usage on desktop appraisals being so low right now, in my opinion, is industry volumes are at record lows, right? And when that happens, there's a ton of appraiser capacity. Appraisers can turn around a traditional appraisal within 4 or 5 days. So there's not this need to use a different option to close a loan. Lenders don't want to, order a desktop appraisal because they may blow up a deal, right? A desktop appraisal can come in lower than the contract price, and of course that creates all kinds of concerns for lenders. So when industry volumes are low, they're perfectly fine with leveraging an interior exterior appraisal. However, rewind back to when refinance volume was crazy, lenders were looking at easy 4, 5, sometimes 6 weeks to get an appraisal ordered. In those cases, and when that volume comes back, we will see an uptick, in my opinion, in the usage of desktop appraisals. Next slide, please. And then the last one I wanted to talk a little bit about is this concept of a hybrid appraisal. This is not broadly available in our guide. We are actively testing hybrid appraisals as part of appraisal modernization. And what's a hybrid appraisal, you might ask? So a hybrid appraisal is one where the appraiser will develop the appraisal report by leveraging a property data report that's completed by a trained data collector. So we've split out kind of the person who's going out to the property, collecting all the information from the appraiser who's actually doing the analysis. Now, of course, there's concerns with this, like how do you know you're going to get comprehensive photos? How do you know that the Uber driver is not visiting the property, right? So we've built in a number of different policy requirements that I've got listed here. One of which is requirements specific to the data collector themselves, which are, by the way, the same for ACE Plus PDR. Data collectors have to be trained. We've incorporated kind of independence requirements for data collectors. And the reason for that, a little bit of background on that, is most of the appraisal management companies who have operationalized property data collectors leverage real estate agents to be their property data collectors. So real estate agents are on their panels to perform that work. And of course, we worry about independence, right? We want the agent who's performing the property data collection to be independent from the transaction itself. So we have a number of policy mitigants that are very explicit to ensure that we have that independence is maintained, similar to how we have appraiser independence requirements in our guide. So we've been testing hybrid appraisals for a little while now, and testing has been very favorable, good positive results. We're seeing more accurate assessment of the subject property's condition, which obviously is a critical input for selecting comparable sales, as an example. We've seen a reduction in the frequency of when appraisers kind of neglect to call out repairs or inspections on property, which is also important for us, and an overall reduction in overvaluation risk. And then during peak volume periods, which right now clearly we're not in one in a peak volume period, but during peak volume periods, we also saw improvements in the turn time, how long it takes to fulfill a hybrid appraisal as compared to a traditional interior exterior appraisal. So the results have been, fairly positive, and we will continue to kind of refine the policy and work towards incorporating this as a potential broad offering. So with that, hopefully that was provided some good kind of insights, overview, and what we're up to. And I'll turn it back over to Mike.
Thank you, Tanya. I thought that was great. I worked with you, and I'm learning things as you went through that. And to me, and hopefully a lot of our attendees, what you're describing makes sense, right? If you've been in the business and you've had to go through the purchase transaction or a mortgage transaction, improving that process, I think, is very welcomed. We have set aside a few minutes to take questions, Cindy. So I don't know if questions have come forth. We're happy to take them, or we can do a wrap and give people back a couple minutes.
Yeah, no, we do have a couple of questions, and actually, let me give you one to Tanya just to follow up. Do we anticipate a shift of volume from traditional appraisals to other valuation methods beyond ACE?
Good question. So as I kind of discussed with ACE PDR, we do anticipate increased usage of ACE plus PDR going into next year. One of the things I think it's worth mentioning is both GSEs, Fannie and Freddie, created an aligned data set to support the property data collection offering, which, as I discussed, supports both ACE plus PDR and hybrid appraisals. And we announced this aligned data set in October of this year in our October bulletin. And we, Freddie Mac, will require this data set to be used come April of next year. So I do anticipate that more lenders will begin to operationalize the use of this capability going into next year, second, third, fourth quarter of next year.
Okay. And another one for you, Tanya. How does Freddie Mac get comfortable with property condition if no one is going to the property?
That's a great question, and one I get often, right? How do you know? How will you get comfortable? So, in single family, we have a dedicated collateral team of appraisers, actually, who perform QC on all of our valuation methods to make sure that we are staying on top of any blind spots. And for ACE specifically, we're ACE, right? We're offering an appraisal waiver. We're waiving the requirement for an appraisal. We perform a monthly QC, both on a random and a targeted sample basis. We look at all ACE funded loans to assess whether kind of performance, whether ACE made the right decision or not. And if a loan was delivered with ACE, we leverage other tools to help us get comfortable. We order desktop appraisals. We, believe it or not, we order drone services, flying drones over houses to get a view, kind of a physical exterior view of the property. We leverage all the third-party data sources, as well as any current or prior appraisals on that property. We also have the ability to look at loans where we offered ACE, but these loans were delivered with an appraisal, and it provides us a great, unique opportunity to use that appraisal to see, did we make the right decision in ACE or not? ACE obviously is leveraged quite a bit. If we offer it, lenders usually take us up on the ACE offer, but there are some lenders that haven't operationalized the use of ACE. So it gives us great insights into leveraging that actual appraisal on that transaction to see, did ACE make a right decision or not? And like I said, so far the results have been, fairly positive. We're pleased with the results, and we, continue to monitor performance and make adjustments when needed.
Great, thank you. That was some great information. Mike, we have a couple for you. When and at what levels will Freddie Mac issue lower down the stack?
I don't know if we have a specific number. I think if we can, Cindy, jump back to slide 15, Can you go back to 15?
Oh, I can. Let me see.
So let's look further down the stack means B1, B2. That's what that's referring to. And you can see the last prints that we had for high LTV deals on the right-hand side. B2 is 1,100. B1 was 700. And you go back to 20 HQA5, 21 HQA1, right in the middle of that. He's got that dotted line, which is the low. So the last print we did on a B2 was nearly double the tights that we saw on that B2. I actually look at the tights way over on the left-hand side, right, 510, more than double. And you see a really similar pattern for that B1. So I would say the market, despite continued really very, very strong performance and multiple years of performance, year after year after year, we've gone through COVID, something that was completely unprecedented. Despite actual losses, and these are credit risk transfer transactions, despite actual losses being extremely low, we're seeing spreads that are, from a historical perspective, very, very, very wide. And I could even argue that I'm not sure that those spreads were completely based on the actual performance, expected performance. And I get it; things can always change, and it's a market, and we feel very confident that our distribution process is well represented. As I said earlier, it's over 125 unique investors, but I would say there's a long way to go on both of those B1s and B2s before those look very attractive to us. That said, we could always take a different view of the market, and we may find even at certain spread levels, same spread levels, different strategy from we may find something more or less attractive.
Okay, great. We actually just got a question in from Andrew. The question is, has the performance of ACE versus pure loans been assessed in the aftermath of a natural catastrophe event, such as a hurricane?
Yes, we look at it both ways, and performance is similar.
Okay, thank you. And it looks like our final question, Mike, we'll ask you, what is the projected 2024 issuance volume, and what is the anticipated stacker ACEs mix?
Generally speaking, the stacker ACEs mix is about 75% stacker, 25% ACEs. This year we finished, past couple of years we finished a little bit higher, 70-30, or maybe even as much as a 65-35 split in terms of ACEs being higher. But I would think that we're going to be in that same ballpark going forward. Let's call it more around a 70-30 mix, plus or minus. And the total volumes are down. Guaranteed volumes at the company are down, so that's going to flow into you. And you can track our pipeline report that we put on Clarity. You can see the volumes. You can see the credit characteristics of the potential pipeline. So volumes are down. I think coming into this year, we estimated issuance would be in the 4 to 6 billion range. We're going to finish the year at the lower end of that. I think I'd probably repeat that guidance for next year, probably in that 4 to 6 billion range. But we gotta give ourselves a little bit more time. And I think early in the year we'll come out and we'll do some. That was not an official guidance there. Yeah, we'll come back in the beginning of the year and we'll try to update what that estimate is. But I would think it's something in the vicinity of what we issued here in 2023.
Okay, great. I'm going to go back down to our slides. I thought we had another slide after the question slide. I just want to make sure. Okay. Our thank you slide. Okay. Any final words, Mike?
No, that's it. Again, Tanya, thank you so much. I found that really, really helpful. And I know that you had to prepare a lot for this, and just generally speaking, your team is highly active in this space. Really, really important to get. As you mentioned, right, when we're talking about mortgage risk, collateral is key. And thanks to all of the folks. I think we had roughly 100 people that signed on today. So appreciate your time and your general support for the market. As I mentioned, this is our last webinar for the year, and I really enjoy being able to come out here and help share some of this insight, and hopefully you found it valuable. Please send us any input or feedback that you have, and we can try to make improvements as we go forward. Thanks, and have a good holiday, everyone.